YouTube.
You're good. It'll be starting any second now. There we go. Welcome everybody. Looking forward. I'm actually really excited about today's call. I'm going to try to show a lot of restraint tonight because I think that for everybody who's involved in Telegram, you saw my message. This strategy that we're going to talk about today, while it's actually not one that I trade live at all, it's just not one that I trade, but it represents the key building block, in my opinion, to understanding butterflies, which is my favorite option strategy to trade. So I've got to show some restraint. I can't talk about butterflies too much. I will kind of point to why I say that this is the key building block to butterflies at the end of today's call. But that's where we're going with this. We're on this journey trying to learn from the most basic option strategies to then start building more advanced strategies. And the purpose of advanced strategies is to try to set yourself up so that you can protect yourself from the open. It doesn't mean that you're wiping all risk off the table. That's impossible to do. But it means that you can start to set some tighter risk parameters for yourself to hopefully protect your account while you're trading. All right. So as always, we have to trade responsibly. Past performance, whether actual or indicated by historical tests and strategies, is no guarantee of future performance or success. There's a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. So the short straddle. It's if you remember from a couple weeks ago, we talked about the long straddle. The short straddle is the exact opposite. So rather than buying rather than buying a call and a put at the money with the same expiration, we will be selling the call and the put at the money with the same expiration. And so if the construction is the opposite, then the market landscape should be the opposite too. Sometimes when I put on trades and they don't go my way, I find it amusing. And I do find it amusing because when I just get where I'm going with this, I'm never going to put on a trade that hits me so bad that my account is in trouble from that one trade. So I can look at it even when I take a loss, and I can be amused by the fact that had I done the exact opposite, then I would be making money right now. So whatever trade I put on, if it's wrong, if I bought this spread to open it, well, if I would have sold that spread to open it, well, I'd be super, super great right now. So it's always fun to think about spreads from that perspective. So last time we were buying to open to expect a rise in volatility. Well, this time if we're selling, then we want a drop in volatility. So we're expecting that there's an important event or catalyst that has spiked volatility, and then we want it to come down. And we expect that price may make a significant move away from the daily moving average, but likely settle and retrace back to the means. Now, I decided, just because I wanted to drive this point home, I decided to pop some slides in from last presentation, just to really quickly put it in our mind. I'm going to construct the long straddle one more time. So it's a long call. It's a long put together, and we have the long straddle. Reverse that now. So now we're selling the put. We're selling the call. I have a super scratchy throat today. Some of you drinking a lot of water, so excuse me. And so now notice we construct the short straddle. We can still see the straddle risk outline, but it's moving in the opposite direction. So to look at the long one more time, notice that these are mirror images of each other because we're constructing them in the opposite fashion. All right. So today we're talking about the short straddle. And the problem with a short straddle is the exponential loss potential from putting on one of these strategies, right? Because if we are short a call or short a put, if price really moves far away from our center and gets out past this boundary, it can just keep going and tear our account up. And so obviously, most of us are not going to just trade this strategy live, but it's super important to understand it as a key building block for what comes next. All right. So here's our risk parameters. Imagining that the underlying is trading at $100, then we're selling a short call, we're selling a short put, and we're receiving a massive credit for doing that because we're receiving the credit of at the money strikes. And so what that means is as long as price stays close to the money, then we're going to collect all of the credit received from being short there, because neither one of the strikes get to move far enough into the money, then all their extrinsic value decays and we collect the premium. So that's the idea behind this part of the structure. Obviously, we get too much outside, then all of a sudden the credit received is just not strong enough and we start to take losses. Excuse me. So entry strategies for the short straddle. We're selling to open when volatility is high and options premiums are inflated. We sell before an event like earnings, a split, a merger, government announcement. We've been seeing a lot of that from the Fed recently. That has increased volatility above its historical implied volatility or IV percentage. And we sell at the money so that you receive the highest premium, widening your break evens. So the entry market dynamics: sell to open both call and put at the same time at the money for high credit value. Enter both call and put when volatility is high. So on a Monday or a Friday morning, when in terms of the week, that's when we're going to see a lot of volatility on those particular days, or the week of earnings. In the example, I'm actually going to use another earnings example, or the week leading up to a merger, split, or IPO. Vega and IV are high during volatility events and increase the credit value of the short legs. So the options Greeks, delta and gamma, are both significantly increase the value of the directional side. So that means if we enter the position and then all of a sudden price rockets up, well, now delta and gamma are really working against us because the call that we sold is just inflating in value. And so delta and gamma is going to kind of be a problem. We want those to really chill out once we sell. Theta is going to be beneficial for us though, because theta is going to consistently widen the break evens of our position as more and more time drains away from the calls and the call and the put that we sold. As long as we don't get too large of a delta move, then all that extrinsic value is going to drain out. And if we sell when volatility is high, as that volatility decreases, that helps us as well. All right. So To exit this, option number one is price remains on the strike or within the profitability window, and you simply buy to close the structure for the profit trigger. So you're still going to want to close this without letting it expire. And you want to close it at a profit trigger because it's just a much easier way to manage. Option two is buy to close when one side has decayed in value because of time or price action. So in other words, if you get a really big move up, for example, well, your call is going to be a big problem, but your put is going to be essentially worthless. So if that put is worthless, then you can essentially keep all the premium that you receive from that put by buying to close it. And then that idea is you buy to close that put, and then you hope for a retrace, and that retrace is going to suck the value out of the call, and then you're probably going to be okay in the position because then you can close that call after the retrace. The other option is to buy to open a long position to cap the loss on the failing side. I'm excited to talk about that. This may be the part of the presentation where, if you're like me and when I was new to this and I had this structure I was trying to imagine in my mind, and then all of a sudden we start talking about buying another option, my mind would kind of cloud over and it would feel difficult for me to learn. And I hope that by the end of this presentation, that little piece right there, the buy to open a long position to cap the loss on the failing side, I hope that I can shed a little bit more light on that idea. That's what I'm going to try to do today. So the general thesis on indexes is, since both sides of the position are short, the strategy is not applicable to indexes or high risk value equities. What that's saying is, trying to do this on something like SPX, with the way that it moves, it's moving so far, so fast, it's really, really difficult to get this correct, no matter how big your account is. But depending on your account size and trading privileges, you may be able to execute the strategy on mini cash settled indices like XPS or XND. However, always check for volume and open interest on the mini cash settled indexes to avoid being trapped in a short trade without protection. So what that means is, when we go to sell a position, it's likely that we're going to want to buy to close it at some point. If we sell something with super low open interest and price moves against us, we're going to be hit twice, because first we're going to be hit by the fact that price moved against us, but we're going to be hit again by the fact that the spread is really wide. And so the broker essentially has a lot of leverage over us in that situation. And the way that the broker is going to capitalize on that leverage is keeping the bid-ask spread wide, which makes it so that you have to essentially pay an extra cost to close it. And it's just a difficult place to be in. So you want to make sure that there's ample open interest on the option chain before you get into these positions. So general management is closing the trade while in profit, adding a long position behind the falling short position to create a credit spread on one side, or roll out the date if you believe price is likely to retrace to your strikes after your current expiration date. And as far as management, we never want to risk more than 3 to 5% of our accounts. For me, that's even high. I like to keep, then this is just me personally. You saw me allude to this in the chat. I like to try to keep my positions more like 1 to 2% of my account. That's just the way that I like to manage. So sometimes that helps me. If I'm in a short position, it helps me decide when and how I want to manage that short position. If price is moving against me and all of a sudden it's starting to behave like it wants to take a larger chunk out of my account, then that's one of the ways that I start to think about, like, okay, how can I cap this? Small accounts can use an iron butterfly, we're going to talk about that, to minimize buying power and margin requirements. So that last sentence there is one of the things I'm excited about. Essentially, I keep burying the lead. I'm just going to keep talking and then we'll get there. All right. I'm sorry, guys. Keep saying the same stuff over and over again. So the example that I wanted to give is Tesla. So if you remember on long straddles, we talked about possibly doing an earnings play on Tesla, and we talked about possibly doing an earnings play on Apple. All right. And here we're going to give it remember on Tesla, we were looking at going really far out in time before earnings, capitalizing on volatility. This time, we're actually going to look at selling to open right before earnings actually is announced, because we want to capitalize on that volatility with the idea that we buy to close on the retrace. So if you notice, and this is easy to do, just and cherry pick it in, historically, but it will be illustrative of how these type of trades are set up and how to use them. And then from there, we're going to extrapolate how to turn them into butterflies. All right. So we'll be looking at the 19th of October, earnings, price drops down. We'd be pretty red in here. Price comes back up to our center strikes 6 days later on the 25th. And then we'll be looking at the type of profit that could be expected from a trade like this. And for anybody who wasn't or didn't get a chance to see the call last time, I'm going to use the same tool because I really, really like it. And that is Thinkorswim's Think Back tool. All right. So from the Analyze tab, a lot of us like to look at the risk profile, but we don't always know about the Think Back tab. Think Back tab does is it gives us historical options data. It's going to give us really accurate readings for volatility on specific dates. So you can change the date. Notice right now I have October 19th, but if I change the date, if I click up, we can notice that volatility is changing. If I click down, we can notice that volatility is changing. So I picked October the 19th because just after the market closes, that's when Tesla was reporting earnings. So I could expect that there was going to be high volatility on this option chain. And notice the expiration I chose for this strategy is 30 days out. And the reason that I chose this expiration for a strategy like this is if we're selling volatility before earnings, we should expect a large price move at earnings. And what we're essentially doing is playing the long game and saying, you know what, price is going to make a big move, but it's going to retrace. When it retraces, at that time, I'm going to be able to exit this position, get out with a nice profit because of all the volatility that is not there anymore. Price has already made its move and its retrace. Earnings is over. That volatility and some of the theta is going to be sucked out of this spread. And now I'm okay. Probably shouldn't have called it a spread, so apologies. So the at the money straddle, we would sell to open, a call, and a put. And notice that the credit received is $37, almost 68 cents. All right. And then if we go back to the chart, just to refresh our memory, we're going for the 25th of October. So what we want to do is see how much is this worth on the 25th. And one last thing I want to say about Think Back. Think Back gives us data for how the options are pricing at the close of the day. So it's giving us some parameters to see how different strategies would work. But if you notice, I picked these 2 days because they close in such a similar price range. That's why I picked them. All right. So when you go in yourself and you start doing back testing, you start using that Think Back tool, just have it in mind that it's going to give you data based off of the price that the underlying close that day. Okay, so here we are with the 220 trading for $37.67. Click it up to the 25th. That's still at the money. And I've got to take this off. I think I have to take it off. Let me see. Yep, I do have to take it off or it won't make sense. And you can see now we're trading at $27 and almost 98 cents. So it's about $10 credit received. And it gives us the idea of what those center strikes do when time and volatility decays against them. And so notice that volatility is now at 68% as opposed to 83%. That's a huge change, and that's a huge reason why this strategy works. Now, it's a little bit academic for us because like I've been alluding to this whole time, this is an undefined risk strategy. And so what that means is if we put that on and price just rockets, like Tesla rockets or crashes in one direction or another, then we're in really big trouble because we're short exponential with an exponential loss where one side is just going to keep on running and running and running. And so there's actually a simple way that we can cap that risk. And when we cap that risk, we essentially turn this trade into an iron butterfly. And what all that means is if you notice in the slides, we talked about one of the ways to manage a short straddle is to, once we get a thesis for which way price is going, start buying long options to cap the short from going against us. Well, we can actually do that from the onset of the position. And the way that we would do that, I'll show you on Tesla now, but I actually want to just jump into SPY because they're a little bit smaller numbers, so it's easier to get our minds around. But the way that we would do that is to simply buy out of the money calls and puts. Because if you think about it, if I'm short, let's take this away for a second. And let's think just, I'm short a Tesla call at 220. I collected $20 of credit. That means that I don't want this call to go in the money. If this call is in the money at expiration, then I'm on the hook for however deep in the money it goes. So I actually can make a decision about how deep in the money this ever gets to go. And the way that I do that is by buying a call on top of it. So if I buy, for instance, the 230 on top of it, it's now a vertical, it's a credit spread, because the reason why it's a credit spread and not a debit spread is because by me selling at the money and buying out of the money, the option that I sold is worth more than the option that I bought. And that allows me to collect a credit. What that means is if price falls and this first strike never goes into the money, then I keep the entire $4.90 credit. If price rises, price is capped for how hard it can hit me. It's capped for how far it can go against me at 230. Once price gets up to 230, then the out of the money call that I bought is in the money, and it's going to keep pace with the expanding call that I sold. And by it keeping pace, it's going to prevent an exponential loss. And the easy way to think about it is 220 up to 230 is $10. So the width, we call that the width of the spread. The width of that spread can hurt me for 10 option dollars, which we know is actually $1,000. But because I collected this credit down here, it actually can only hurt me for $5.08 because I collected $4.92. All right. Now do the same thing on the put side. And what you see here is listed as an iron condor, but traders wouldn't call this an iron condor. Traders would call this an iron butterfly because it's selling the same central strike. All right. So essentially what we're doing is trying to capitalize on this credit. And notice it is a smaller credit. It's a $9 credit, but the max risk is capped at however wide the widest spread is. And notice we are $10 wide on both sides. All right. I'm not saying that this is how I would trade an iron butterfly, but I am saying this is how we construct it. And I don't want to fall into a rabbit hole of turning this lesson, excuse me, into an iron butterfly lesson, because it's not. That's not the purpose of today's call. But the idea is that I know that a lot of people in our community are trying to figure out how do butterflies work, how do iron butterflies work, and really they all hinge on the interplay between selling two options and then buying two options out on either side of them. That's really all that they are. And so a butterfly is just a simplified version of this. A butterfly would be, instead of selling a call and a put, we would just sell two calls, and we would buy a call in the money or closer to in the money, and we would buy another call on the other side of it. And so what I would encourage people to do is to take this idea into the option chain and just play around with it and start and not only look at the risk profile, but also look at the cost to entry and start seeing how layering long structures with short structures that are risk defined because we cap them on either side, how that can start to put you into an advantageous position. If you're right, then it can really expand in your favor. If you're wrong, it can't hurt you that bad because you've defined your risk. And so I'm going to construct one more of these on SPY just because I think it's a little bit easier to get our minds around. So let's just look at, and I'm actually going to bring up the actual risk profile. So let's just look at the 407. $6 days out for this example is fine, in my opinion. So again, we construct it the same way. We start with a straddle where we're selling a call, selling a put, and we'll go 10 points wide. And so notice on the call side, as I go further and further out of the money, I'm paying less and less and less, right? So 10 points out. Oh, you know what? I'm sorry. Before I do that, let me just show you the risk profile. And I might have messed around on here a couple of times, so let me take this off. Right now, we see this risk profile with undefined risk. Right? We can see that there's a profit tent. So if we expire in the money and it's hard to read my numbers, it tells us about 677 right now. That's the highest that we can hope to make if it expires in the money with no risk parameter on either side. So if we're wrong, we just start getting crushed. All right. And these numbers just start to get exponential really, really quickly. Now, if I add to this and I build an iron butterfly, for every long that I buy, I'm taking away from my maximum gain, because I'm not buying these for the purpose of driving my profit. I'm buying these to try to make sure that I don't take a massive loss. So we want them to be a little bit out of the money so that we don't overpay for them. So now let's look at the risk profile and how it changes. And all I did there was, we still have this straddle here. I took the straddle off. This risk profile is extremely similar to what just a regular butterfly will look like for anyone who hasn't seen a butterfly before. This is what it will look like. You have a great profit tent in the middle, and then on either side, you have the losses. The losses here are capped at $419. The profit is capped at $553. Now, the reason that I'm just trying to teach this as a concept and not necessarily as a strategy that I would recommend is, even this is a little bit harder to profit from than a butterfly. Butterflies, the way that I like to trade them is I like to treat them almost like you're aiming for a target. And so you kind of set them up where you think price is going, and that will put you in a better reward to risk parameter. Like if you notice, the max gain on this is not much larger than the max loss. That's not a structure that I love for most situations. But conceptually, I just think it's really, really important to start thinking about being short, to finance along, and understanding that can actually set you up for success. And it tends to be a lot less scary the more that you look at it in the option chain, and the more that you look at it on the risk profile, and you see the way that these two things relate to each other. All right. So that is what I wanted to share today. I do feel like I got a little bit in the weeds. I hope I didn't get too far into the weeds. But I'm going to pause here. I'm going to open it up for questions. As always, we have Juanita with me, we have Regina with me, and they're going to ask questions themselves if they arise. There's also, to everybody who's in YouTube, if you're dropping questions into the chat, they're going to help me keep those questions clear. So if there's any questions, any pushes, any comments, things of that nature, let's open up the floor for some dialogue.
No questions in the YouTube, Jay, but I do have a question.
Great.
And it has to do with, I always like to understand really the max loss, but then I thought about an idea of, I have several, like I have shares, for example, of Apple. Is this something I can do if I have maybe lots of shares of a stock, and then doing something? I think of this around Apple because even when Apple has its earnings, it'll do its thing, but a lot of time it'll come right back.
Yeah.
Right back. It doesn't go too far away.
I'm trying to think creatively. The short answer is, if you have shares, then you're always somewhat protected, because really when we do options constructions, those are acting like synthetic shares, right? Like if I buy a call against a short position, I'm doing that to kind of give myself the way that shares would behave. What I would say is that for something like this, I'm not used. There may be traders who do this with the mindset of, oh, I'm holding the shares and that's why I'm doing it this way. I'm not familiar with those strategies. I will say that next week, when we talk about short strangles, or maybe 2 weeks from now, we got to talk about strangles, because we'll go long and then we'll go short. A lot of traders will employ the strangle ideas, which to kind of supplement the shares that they're holding. So I think that's a question I'm going to pass on to Suzanne, because she may be able to answer that better, but that's really what I have.
Okay, thank you.
For sure. This is me just doing my teacher wait time.
So just doing a straight short straddle then. Really, if we need to think of it, because I'm always thinking about what the max loss is on everything, which is why I understand doing the iron fly, the outer legs. I understand to do that. So really, unless you're willing, I guess, to be at risk for shares, essentially you would be at risk for shares if you do it alone, I'm assuming. Since you're going short, long, you're short.
Right, there's going to be, I'm sorry, continue.
Because you're short a call and short a put, then you're at risk if it doesn't come on either for the 100 shares on both sides. Is that?
That's correct. Yeah, and you can only, that is correct. And so really what I think what it would come down to is knowing what price you bought those shares at. And like you'd be looking at your Apple position as like a total position, and like how much of that total position's worth are you trying to risk on a strategy like this? I just don't think that, this is just my opinion. The short straddle is it's a more speculative type of a play. Mm-hmm. Holding a position is a more investment type of a play. And I think that it's hard for me to get my mind around combining those two, because I feel like I feel like it would sort of, because the risk is really there, it's hard for me to it's just hard for me to see why to do it that way, as opposed to doing it like a short strangle. I just think a strangle makes a lot more sense for holding shares than like really dangling them on the line against a straddle, if that makes sense.
Okay. Thank you.
But you know what's going to happen. I'm going to drop that question in the chat for Suzanne, and then who knows what she's going to say. Like, we could both really learn. What I don't want to do is start saying like, oh, well, how about if you do this? And then I'm just sort of making stuff up that, that could be cool, but also is just me kind of nerding out on it. That's not what we want.
Okay. Thank you.
For sure.
No questions in the chat, YouTube chat at this time.
Cool. So this was a pretty dense call. And I hope, the main thing that I wanted to get across, and I hope that I did it, was just the idea that selling options, especially if we compound them, sell two options at the same strike, can collect for us a nice large credit, and to just have some comfortability with that as a concept. Because as we start to build and as we start to get into butterflies, be it unbalanced butterflies, broken wing butterflies, iron flies, what have you, as we get comfortable with understanding each component, the center strikes, what is the purpose of the center strikes? Essentially, the straddle is the center strikes of a butterfly. That's essentially what it is. And when you get into butterflies, I want to say this one more time, you'll just sell 2 calls as opposed to a call and a put, or you'll sell 2 puts. It'll be all on one side of the chain, but the premise really does function in the exact same way. What we talk about with a short straddle is the center of a butterfly. So it's the central idea to a butterfly. It's just that we can extrapolate it to all kinds of other things. So today's call was really about laying that groundwork. I hope that I did it. If there's any more questions about that, great. If not, then I think that we're gonna go ahead and wrap it up here. And this is me practicing a little bit more wait time first. All right, to everybody in YouTube, thanks a lot. Really appreciate it. Regina, Juanita, thank you both very much for being here. Thanks a lot. No, today was a little bit dense. Hope I was clear. Just hope I didn't lose anybody. And as always, please reach out to me in the chat. You can either message me personally, or you can just put those questions up publicly. I think public questions are really great because oftentimes, if one person has a question, so many more people have a question as well. So everybody have a great night, and we'll be talking again next week.